If you think today's headline is about silver hitting $92 per ounce, if you believe this is just another precious metals rally, then you're staring at the symptom while missing the disease. Because what the data is screaming right now is not a forecast. It's not speculation. It's mathematical proof that the United States of America has suffered a catastrophic collapse in its strategic silver position. A collapse so severe, so complete, so irreversible, that it threatens the very foundation of American industrial and military supremacy. The vaults are nearly empty. The supply chain is broken. And the price you see right now is about to explode to levels that will destroy unprepared industries. But here's what nobody's telling you. Welcome to John Analyst, where we don't just report the news, we decode the economic warnings the mainstream won't touch. Now, before we go any further, let me ask you something. You've been around long enough to see markets rise and fall. Governments make promises they can't keep, and strategic mistakes that cost nations their future. So do me a favor. If you value analysis that cuts through the noise, that gives you the truth before the crisis hits, hit that subscribe button right now. Because what I'm about to show you, you won't hear anywhere else. And tell me in the comments, where are you watching this from today? Are you in the States, watching your government scramble? Europe, seeing the supply chains crack? Asia, where the silver is already locked away? Drop your location below. I want to know who's paying attention while there's still time. Now, let's get into what they don't want you to know. This is not about investment thesis. This is not about technical analysis, chart patterns, or moving averages. This is about national security. This is about the United States government waking up to a terrifying realization that they sold off one of the most strategic assets in human history at rock-bottom prices. And now, they cannot get it back. They cannot produce it. They cannot import enough of it. And they are watching in real time as hostile nations stockpile the very material that American weapon systems, American satellites, American AI infrastructure, and the entire green energy transition depend on for basic operation. As of today, January 22nd, 2026, the United States Strategic Silver Reserve has collapsed by 73% from its historical peak. The vaults are nearly empty, the supply chain is broken, the production capacity is gone, and the price you see on your screen right now, $92 per ounce, is about to explode to levels that will reward those who positioned early and destroy those who ignored the warning. Let me take you back to a time when America understood something that modern policymakers have completely forgotten. During World War II and throughout the Cold War, the United States government knew a fundamental truth. Silver is not jewelry. Silver is not a speculative asset. Silver is not optional. Silver is a strategic war material, as critical to national defense as uranium, as titanium, as rare earth elements. Without silver, you cannot build missiles. You cannot build radar systems. You cannot build secure communications infrastructure. You cannot build the weapons that keep a superpower in power. So starting in the 1940s, the United States government, through the Defense Logistics Agency and its predecessors, began accumulating massive strategic stockpiles of silver. These were not investment positions. These were insurance policies. They were designed to ensure that if global supply chains were ever disrupted, if wars broke out, if trade routes were cut, the United States military-industrial complex would have access to the materials it needed to keep functioning. At the peak of the Cold War, the United States National Defense stockpile contained thousands of tons of silver. The exact number was classified. But estimates from congressional budget documents and declassified procurement records suggest the stockpile reached approximately 200 million ounces or more at various points between 1950 and 1980. That silver sat in vaults in Texas and Louisiana. It sat in secure facilities overseen by the Defense Logistics Agency. It was audited, cataloged, ready, and then the Soviet Union collapsed. The Cold War ended. The Washington Consensus declared that history was over and free markets had won. And someone in the Clinton administration looked at the balance sheet and asked a question that would haunt America for decades. Why are we storing all this silver? We can sell it and use the money for other programs. We can liquidate the stockpile, pocket the cash, and if we ever need silver in the future, we'll just buy it on the open market. It'll be cheaper. It'll be more efficient. What could possibly go wrong? So they started selling. Throughout the 1990s, the United States government systematically liquidated the national defense stockpile. They sold silver at $8 per ounce. They sold at $6 per ounce. They sold at $5 per ounce during the commodities bear market. They dumped millions of ounces onto the market year after year, driving prices down, destroying the domestic silver mining industry, and convincing the entire world that silver was a relic of the past with no strategic value. By the year 2000, the liquidation was complete. The national defense stockpile contained virtually 0 ounces of silver, The Defense Logistics Agency's official inventory reports, which are public record, confirm that silver is not currently held in the stockpile. It is gone. All of it sold, spent, vaporized. Now let me show you where that decision has left the United States in 2026. The United States, which once held 200 million ounces in strategic reserves, now holds effectively zero. The United States Mint has a small working inventory, maybe 50 to 60 tons, but that is pipeline stock for producing coins. It is not a strategic reserve. It is inventory for the next few weeks of production. If there is a supply disruption, if imports are cut off, that inventory lasts maybe 30 days before the mint stops producing silver eagles and the market panics. That is it. That is the entire buffer. 30 days. And the collapse is even worse when you examine domestic production capacity. The United States is now a net importer of silver, according to the United States Geological Survey, which tracks mineral supply and demand. The United States imports between 67% and 80% of the silver it consumes every single year. Let me repeat that. The United States, the world's largest economy, the world's most powerful military, imports up to 80% of its silver. 80%. That means 80% of the silver that goes into American missiles, American satellites, American solar panels, American electric vehicles, American AI chips comes from foreign countries, primarily Mexico, Canada, and Peru. Countries that are now facing pressure from China to redirect their silver exports. Countries that are implementing higher royalties and export taxes on silver. Countries that could, at any moment, decide that their own national interests require keeping silver at home rather than sending it to the United States. This is strategic dependence. This is vulnerability. This is the exact scenario that the National Defense Stockpile was designed to prevent, and it gets worse. Because the 73% collapse that we're looking at right now is not just about the stockpile being sold off. It's about the total loss of strategic optionality. Let me show you what that means in practical terms. In 1980, if there was a supply disruption, the United States had options. They had 200 million ounces sitting in the vault. They had domestic mining operations that could ramp up production. They had refining capacity on American soil. They had expertise, engineers, geologists who knew how to extract silver efficiently. They could survive a crisis. Fast forward to 2026. If there is a supply disruption today, the United States has no options. The vault is empty. Domestic mining production is minimal. Refining capacity has been moved offshore. The expertise has either retired or moved to other industries. If Mexico decides tomorrow to ban silver exports, if Canada imposes strategic export controls, if Peru nationalizes its mines, the United States industrial base has maybe 60 to 90 days of inventory before production lines start shutting down. That's the 73% collapse. It's not just the metal that's gone. It's the capacity, the infrastructure, the strategic depth. All of it, gone. And here's where the nightmare really begins. The government knows it. That's why on August 25th, 2025, the United States Department of the Interior, through the United States Geological Survey, added silver to the official list of critical minerals for the first time in history. This was not a symbolic gesture. This was a formal acknowledgement that the United States economy cannot function without silver, and that current supply chains are unacceptably vulnerable. By placing silver on the critical minerals list alongside lithium, cobalt, rare earth elements, and other strategic materials, the government has admitted what analysts have been saying for years. Silver is not a commodity. It is a weapon. It is infrastructure. It is national security. And the United States does not have enough of it. Now, the critical minerals designation opens the door to a range of policy responses. It allows the government to invoke the Defense Production Act, which gives the president the authority to direct private companies to prioritize production for national security purposes. It allows subsidies for domestic mining operations. It allows preferential permitting for new silver mines. It allows trade measures to secure reliable supply sources. And most importantly, it allows the government to rebuild the national defense stockpile through direct purchases. But here's the problem. They're late. They are catastrophically late. They sold the stockpile at $8 per ounce in the 1990s. Now they need to buy it back at $92 per ounce and rising. They liquidated 200 million ounces at an average price of maybe $7. That generated $1.4 billion in revenue. That was spent on programs nobody even remembers from the 90s. Now, to replace that silver at current prices would cost $18.4 billion. That is a 13-to-1 loss. That is the cost of strategic incompetence. But it gets worse, because they cannot actually buy it back. There is no silver available at scale. If the United States government tried to buy 200 million ounces on the open market today, the price would not stay at $92. It would go vertical. Why? Because the global silver market is already in a structural deficit, and has been for 5 consecutive years. Let me show you the supply-demand mathematics that makes a United States strategic stockpile rebuild mathematically impossible at current prices. According to data from the Silver Institute and Fitch Solutions BMI, the global silver market has been in deficit for 5 years straight. 2021, deficit. 2022, deficit. 2023, deficit. 2024, deficit. 2025, deficit. In 2025 alone, global silver demand reached approximately 1.24 billion ounces. Total supply, including mine production and recycling, reached approximately 1.01 billion ounces. That is a deficit of 230 million ounces in a single year. Think about that number. That deficit is larger than the entire United States historical stockpile. The market is already consuming more silver than it produces, by a margin equal to what the United States government sold off, and 2026 is projected to be worse. Fitch Solutions. BMI projects the deficit to continue at 95 million to 117 million ounces, even under optimistic scenarios. But those projections are based on industrial demand moderating, and that's not happening. Industrial demand is accelerating. Solar panel production consumed over 200 million ounces in 2025. Electric vehicle production is ramping up globally. AI data centers are being built at unprecedented scale. 5G infrastructure is expanding across every continent. Every single one of these sectors requires silver, lots of silver, and there is no substitute. You cannot build a solar panel without silver paste. You cannot build an EV battery management system without silver contacts. You cannot build a high-performance AI chip without silver bonding wires. It has to be silver. Nothing else works. So when the United States government looks at rebuilding a strategic stockpile, they're not just competing with other investors. They're competing with Tesla. They're competing with Samsung. They're competing with First Solar. They're competing with NVIDIA. They're competing with every industrial buyer on Earth who needs silver to keep their factories running. And all of those buyers have the same realization hitting them at the same time. There is not enough silver. The vaults are empty. And if I don't secure my supply now, my production line shuts down in 6 months. This creates panic buying. This creates hoarding. This creates a feedback loop where rising prices do not bring out more supply, because the supply does not exist. And that brings us to what's happening in the vaults right now, because this is where theory meets reality, and the numbers are absolutely brutal. The COMEX, the commodity exchange in New York, is supposed to be the primary mechanism for price discovery and physical delivery of silver in the Western world. COMEX registered inventory is the silver that is warranted and available for immediate delivery against futures contracts. It is the metal that backs the paper market. And it has collapsed. According to data from the CME group, COMEX registered silver inventory has declined by over 70% from its 2020 peak. In 2020, registered inventory sat at approximately 346 million ounces. By late 2023, it had fallen to 82 million ounces. That is a drop of 264 million ounces. That is 76%. And the bleeding has accelerated in 2026. Between early January and mid-January 2026, in just 7 days, 33.45 million ounces of silver were physically withdrawn from COMEX for delivery. That is 26% of the remaining registered inventory disappearing in 1 week. 1 week. At that rate of drainage, the COMEX vault will be empty by March. Let me put that in perspective. The United States government, if they wanted to rebuild even half of the historical strategic stockpile, would need to buy 100 million ounces. The entire COMEX registered inventory right now is maybe 60 to 70 million ounces after the January withdrawals. They cannot do it. The metal is not there. Even if they offered a premium, even if they invoked national security, even if they forced industrial buyers to sell, they cannot rebuild the stockpile. Because the silver has left the vaults. It has been delivered. It is sitting in factories in China, in battery plants in South Korea, in solar panel manufacturing facilities across Asia, and it is not coming back. This is the crisis. This is why Bank of America issued a forecast on January 5th, 2026, that silver could reach between $135 and $139 per ounce. Not because they are bullish, but because their analysts ran the math and realized that at current prices, there is no mechanism to balance supply and demand. Price has to rise until industrial buyers start canceling projects. Price has to rise until some marginal use case becomes uneconomical. Price has to rise until demand is destroyed. And based on the cost structure of solar panels, EVs, and AI chips, silver would need to reach $180 to $250 per ounce before manufacturers start redesigning products to use less silver. At $92, Silver represents 0.2 to 0.4% of the total cost of an electric vehicle. Even at $150, it is still less than 1%. They will pay it. They have no choice. But here's where the story takes a darker turn. Because while the United States is scrambling to figure out how to secure silver supply, China has already executed a strategic checkmate. On January 1st, 2026, 22 days ago, China implemented new export licensing requirements for refined silver. This is the most significant commodity policy shift in decades, and almost nobody is talking about it. China controls approximately 60 to 70% of global silver refining capacity. Let me say that again. Even when silver ore is mined in Mexico, or Peru, or Australia, most of that ore gets shipped to China for refining, because that is where the smelters are. That is where the capacity was built over 30 years of deliberate industrial policy. That is where the expertise exists. For decades, Western manufacturers could source refined silver from Chinese refiners. They had relationships. They had contracts. They could get metal. On January 1st, that ended. The new licensing system requires any company exporting silver from China to have annual production capacity of at least 80 tons and credit lines of at least $30 million. That sounds reasonable, until you realize it is designed to disqualify hundreds of small and mid-sized refiners who used to supply Western markets. If you don't meet the threshold, you don't get a license. If you don't get a license, your silver stays in China. Where does it go? It goes to BYD. It goes to KTL. It goes to Chinese solar manufacturers. It goes to Chinese defense contractors. It does not go to the United States. This is resource nationalism. This is China saying, we refine the silver, we decide who gets it, and our industries come first. The impact is immediate and measurable. Western manufacturers are reporting that Chinese suppliers who used to deliver silver on 30-day terms are now saying, we cannot export, find another source. And there is no other source. Mexico and Peru produce ore, but they don't have the refining capacity to process it domestically at scale. So the ore still goes to China, gets refined, and stays in China. The United States is cut off from 60 to 70% of global refining capacity. That is an additional 100 to 120 million ounces per year removed from available supply to Western buyers. Add that to the 230 million ounce structural deficit, and you are looking at a total supply shortfall of 350 million ounces annually. There is no vault big enough to fill that hole. There's no price low enough to bring out that much selling. The market is broken. And the United States government is waking up to the fact that they are utterly dependent on a hostile power for access to a material that their entire economy runs on. This is the reverse of the oil embargo of 1973. Except this time, the United States is not being cut off from oil. They are being cut off from silver. And there is no strategic petroleum reserve equivalent to cushion the blow, because they sold it. They sold the whole thing. Now let me show you why the spring target matters. Why $135 by April or May 2026 is not just a price forecast, but a timeline for industrial crisis. The solar industry operates on quarterly procurement cycles. Right now, in late January, solar manufacturers are finalizing contracts for Q2 production. They need to lock in silver supply for April, May, June. If they cannot secure silver at reasonable prices, they have to make a decision. Do they pay the premium and accept lower margins? Or do they cut production and miss revenue targets? At $92 per ounce with $20 to $30 premiums for physical delivery, they are already paying $115 to $120. That is painful, but manageable. If silver goes to $135 and premiums widen to $40, they are paying $175. At that point, some marginal projects become uneconomical. Some solar farms that were planned for late 2026 get delayed. Some utility-scale installations get canceled. Demand starts to get rationed by price. That is what Bank of America is modeling. They are saying that by spring, when Q2 procurement is in full swing, when manufacturers realize they cannot get enough metal, when panic sets in, the price will have to rise to $135 to clear the market. That is the spring target. That is the moment when the paper price catches up to the physical reality. That is when COMEX either delivers or defaults. And the odds of default are rising every single day. Let me show you the March delivery crisis that is brewing right now. March is a major delivery month for COMEX silver futures. Right now, there are tens of thousands of contracts in the March window. Each contract represents 5,000 ounces. If even 10% of those contracts stand for delivery, that is tens of millions of ounces demanded from a vault that has maybe 60 to 70 million ounces left after the January drain. If 15% stand for delivery, the vault cannot fulfill it. COMEX will have to implement emergency measures. They will raise margin requirements to force speculators out. They will offer cash settlement incentives. They will extend delivery windows. They will do anything to avoid admitting that the vault is empty. But the industrial buyers are not going to accept cash settlement. They need the metal. They will demand delivery. They will sue if they don't get it. And when COMEX defaults, when the exchange admits that it cannot deliver physical silver against its contracts, the entire paper pricing mechanism collapses. The price on your screen becomes meaningless. Bid-ask spreads blow out to $50. Dealers stop taking orders. The only price that matters is what you can negotiate privately with a refiner or a miner, and that price is going to be whatever the buyer is willing to pay. If you are Samsung and you need 50 million ounces to keep your Texas battery factory running, you're not negotiating. You're paying. You're paying 150. You're paying 200. You're paying whatever it takes. Because the alternative is shutting down a $17 billion facility and watching your stock crash 30%. This is why the United States government is in full panic mode. This is why they added silver to the critical minerals list. This is why there are rumors that the Defense Logistics Agency is quietly approaching major miners to negotiate long-term supply contracts. This is why there is talk in Washington about invoking the Defense Production Act to mandate that domestic silver production goes to strategic industries first. They know the crisis is here. They know the vaults are empty. They know that if the supply chain breaks, American industrial capacity goes offline, and they are scrambling to find solutions. But there are no easy solutions. You cannot just restart a silver mine that was closed in the 90s. It takes 5 to 10 years to get permits. It takes another 3 to 5 years to build the infrastructure. From discovery to first production, you're looking at 10 to 15 years. The supply response is a decade away. The crisis is happening now. So what are they going to do? They are going to buy. They're going to buy at $92. They're going to buy at $135. They're going to buy at $200 if they have to. Because the alternative is admitting that the United States is no longer a superpower, that it cannot build the weapons it needs to defend itself, that it cannot compete in the industries of the future, that it sold off its strategic reserves for short-term budget relief, and now it is paying the price with long-term national decline. That is the real story of the 73% collapse. It's not just about the metal, it's about the loss of optionality. It's about the loss of strategic depth. It's about the United States government making a catastrophic decision in the 1990s, and the consequences of that decision coming due right now in 2026. Now, let me connect this to what decision makers need to understand. Because the government's crisis represents a fundamental shift in global economic power. When a superpower realizes it has lost access to a strategic material, when it starts buying at any price, when it invokes emergency powers and starts stockpiling, the price does not go down. It goes up, fast, violently, permanently. We saw this with rare earth elements when China threatened export bans. We saw this with semiconductors during the chip shortage. We saw this with oil during the Arab embargo. Every single time a critical material becomes scarce and governments start competing with industry for supply, the price explodes. And silver is more critical than any of those. Because silver is in everything. It is in consumer electronics. It is in vehicles. It is in the solar panels powering the energy transition. It is in the missile defense systems protecting national borders. It is in the satellites providing GPS and communications. It is irreplaceable in current technologies. It is consumed and embedded in products. It is not sitting in vaults waiting to be sold. It is gone, locked away in products that will not be recycled for decades. So when the scramble starts, when the United States government announces a strategic stockpile program, when China tightens export controls further, when India starts accelerating purchases, when Saudi Arabia allocates oil revenues to silver acquisitions, there's not enough metal to satisfy everyone. Price becomes the only mechanism that can ration demand, and that price is going to be significantly higher than $92. Bank of America's $135 spring target represents the baseline scenario. That is the floor. That is what happens if everything goes according to plan and the crisis unfolds in an orderly manner. If anything goes wrong, if there is a black swan event, if a major mine has an accident, if geopolitical tensions escalate, if COMEX defaults, the market is not stopping at 135. It is going to the upper end of Bank of America's range. It is testing 200, potentially 300. And at $300 per ounce, the mathematics change for everyone. At 300, silver transitions from being a commodity to being a strategic currency. It goes from being an input cost to being a store of value. It goes from something that manufacturers buy to something that governments hoard. And once that psychological shift happens, once silver is remonetized in the public consciousness, the price does not come back down. It stays elevated. It stays volatile. It becomes a permanent feature of the new global financial system. This is what the 73% collapse in the United States Strategic Reserve is signaling. It is signaling that the era of cheap, abundant silver is over. It is signaling that the countries that secured supply early are going to dominate the industries of the future. It is signaling that the countries that sold off their reserves, that relied on just-in-time supply chains, that assumed markets would always function smoothly, are about to learn a very expensive lesson. And that lesson is going to cost them hundreds of billions of dollars in economic output, thousands of factory jobs, and potentially their status as global industrial leaders. Look at what the strategically positioned nations are doing. Russia is allocating state funds to build silver reserves. China is locking up 60 to 70% of global refining capacity. India has accumulated over 900 million ounces in the last 5 years. These are not investment decisions. These are national security decisions. These are preparations for a world where silver scarcity becomes a weapon, where access to refining capacity determines who can build the technologies of the future, where industrial dominance flows to those who control critical material supply chains. The window for strategic positioning is closing. Right now, silver is still available at $92. But when 135 locks in this spring, when the mainstream financial media starts covering the silver shortage, when corporate procurement departments realize they cannot secure supply, it will be too late. Physical delivery premiums will widen to $60 over spot. Wait times will extend to 6 months or more. Dealers will be sold out. The market will be dysfunctional. The United States Strategic Silver Reserve collapsed by 73% because policymakers made a catastrophic decision during a period of complacency. They assumed markets would always function. They assumed supply would always be available. They assumed strategic depth was unnecessary in the post-Cold War world. They were wrong. And now, in January 2026, as industrial buyers scramble for supply, as China restricts exports, as COMEX vaults drain, as the spring target approaches, the consequences of that error are becoming undeniable. This is not speculation. This is not fear-mongering. This is mathematical reality. The 73% collapse is the warning. The $135 spring target is the timeline. And every day that passes, another 30 million ounces leaves Western vaults and goes to Asia. Every day that passes, the supply shortfall grows larger. Every day that passes, the window closes a little more. By March, when COMEX faces its delivery test, the market will know whether the paper pricing system can survive. By April, when the spring target hits, industrial buyers will know whether their supply chains are secure. The United States government sold the most strategic asset in modern industrial history at the worst possible time. Now they're going to pay whatever it takes to get it back. The only question is, at what price will the market finally clear? 135, 200, 300? The strategic reserve is gone. The vaults are empty. The crisis is here. And the only participants who will navigate this successfully are those who understood the mathematics before everyone else figured it out. This is the story of January 2026. This is the warning that time is running out. And this is the economic reality that will define the next phase of global industrial competition.